Good afternoon, everybody, and a warm welcome to Reverse Mortgages, one of my favorite webinars. I'm Cindy Bishop of Cindy Bishop Worldwide, and it's a pleasure, blah, 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 to introduce our esteemed master instructor today, Kelly Katalinas. Now let's turn our attention to Kelly because I want to talk about her a little bit because you may or may not have had her before as an instructor. She is a seasoned mortgage loan officer. We were just talking about how long both of us have been in the business. I was in 1988. She was in the mortgage business in 1986. Wow. Okay, so more than 3 decades of experience, or whatever that is now, like almost 4. Kelly has not only excelled in her career, but has also become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production and cultivating lead generation, which we see that in a lot of her amazing presentations, which one is next week, Sweet Treat Marketing, 11 to 12 on the 14th. You will really want to attend that. That is a wonderful class. And it's at cindybishopworldwide.com to upcoming events to webinars. It's one of my favorites. I think it's so useful for agents. In recognition of her outstanding contributions, Kelly has been honored to receive the Lifetime Achievement Award by the Washingtonian Magazine. Additionally, she has received the 5-Star Professional Award for the 4th straight year, which was bestowed upon 3 out of 4,600 individuals in the Washington, D.C. area in 2024. These are just some of the many professional awards that Kelly has received. What truly sets Kelly apart is the trust and admiration she's earned from her clients and agents, with over 95% of her business coming from referrals. Today, Kelly's going to share her expertise on reverse mortgages. So without further ado, please join me in extending a warm welcome to Kelly.
Thank you. I so appreciate you being here today. This is a wonderful program to think about for yourself or your clients that might be eligible, and I'm going to jump right in. And a lot of the presentation that I do today comes from the perspective of the consumer. There are agent-specific things because you can do purchase transactions with a reverse mortgage, and we're going to touch on that a little bit. But I think if you understand it yourself as a consumer, you're going to see the value of it, whether you're working with seniors and they want to buy their next home, or you know people that want to stay in their current home, and this could be a solve for them. So let's move to the next. So we're going to introduce what it is. We're going to talk about how we qualify and options, how you can use the reverse mortgage, what does loan maturity look like, and of course, why Fairway. We just came out with our stats in terms of reverse lending nationally, and we are the 5th largest reverse lender in the country. So let's just pop right in and introduce it. So I could always ask this question and get a million responses, right? I'll say, what is your opinion of a reverse mortgage? And you'll hear a handful of people raise their hand and say they're great because they understand the value of them and the options with them. And then you hear other things that are locked in the past where they're saying, I've heard some bad things about them, but I want to know more and learn the facts. So that's what we're here to talk about today. If you ask yourself, why wouldn't you get a reverse mortgage? Wade Pfau is a PhD and has written numerous books on the value of a reverse mortgage in terms of including it in your long-term retirement planning strategies, okay? And basically his premise is that if you strategically use a reverse mortgage, you can greatly improve the longevity of your retirement nest egg and income. Okay, and we're going to show that a little bit as we go through the presentation. So again, if you're age 62 or older and you're planning for retirement, when you get into this realm, there's a lot of things you're concerned about, right? As soon as you move away from regular W-2 or 1099 earnings, you're concerned, like most, about market volatility and inflation and its impact on your retirement nest egg. Your number one concern for people considering retirement, outliving your savings. Number one concern, okay? People are living longer in general, and they're very concerned about running out of their money in retirement, making monthly mortgage payments on a fixed income, and not being able to continue to live in your home in a safe and sustainable way, Okay, so a reverse mortgage loan could be a solution if you've got concerns about any of those items. So let's just define what it is, okay? And the loan that we're going to talk about the most today is a loan through the Federal Housing Authority, the FHA Home Equity Conversion Mortgage, or affectionately called HECM, because 98% of mortgages that are reverse mortgages done in the United States are this type of loan. So we're going to talk about the most common. So the reverse mortgage loan is exclusively for those age 62 or older. It can convert a percentage of the equity in your home into tax-free cash. There are no required monthly principal and interest payments, okay? You still have to make your taxes, property tax, and homeowners insurance payments. There are no escrows on this loan. So you continue to pay your taxes and insurance, like regular, only it's not going to be included in a mortgage payment because there is no required mortgage payment on this program. The home equity conversion mortgage is the most used reverse mortgage in the United States. It launched in '89 and it has had numerous modifications since 1989, constantly improving consumer protections on this loan as a result. Okay, so it's nothing like it was when it first rolled out. It's got a lot more protection in it for the average consumer. It is insured by the Federal Housing Administration. And again, it's for those age 62 or older. So aren't reverse mortgages just a loan of last resort? And I really want you to get out of your mindset in thinking that you should only consider a reverse mortgage once a borrower or owner has exhausted all of their other earnings. Okay, I would argue that a reverse mortgage could be used for very affluent people or relatively affluent people as a strategy for continuing to build their retirement portfolio and creating additional options for them. So let's talk about it, right? Primary reasons to get a reverse mortgage. First, it could be need, right? Maybe someone has taken a tumble and they need in-home care. They don't want to go into assisted living, but they need additional monies to pay for in-home care coming into their home. And their home is adequate for them to age in place or to recover. Maybe they want a reverse mortgage for lifestyle enhancement. They're sitting on a property that they have a ton of equity in, or it's a baby boomer that doesn't want to leave the property but is running short to live the life that they want to live in retirement. Or they want to pay for things that are not in the budget, like travel. Okay. It's financial planners, when we talk to your financial planner about the opportunity with a reverse mortgage, they absolutely love this program because it provides an option to figure out where the best way to keep funds growing for you should remain. Okay. It's great to own a home free and clear. It's a wonderful point of pride, or to have a lot of equity in your property. But let's face it, the only time you're going to have that work for you is if you sell the home or if you pass away and you leave it to your children, versus possibly tapping into it and living the life that you want to live the way you want to live it in your retirement. Okay. So pros and cons, right? The pros, it's a great source of cash flow, or can be. There's no monthly principal and interest payments. Again, you still have to pay the taxes and insurance and maintain the home. And it's a non-recourse loan. We're going to define non-recourse later, but in a nutshell, what non-recourse means is the house will always satisfy the mortgage balance owed on it under a HECM reverse mortgage. In short, if I gave you an example, if the reverse mortgage climbed to 350,000 and the house was worth 300 and you passed away or you vacated the property permanently, you could sign a deed in lieu back to the lender, and the house satisfies that delta or deficit between value and loan balance. That's what mortgage insurance, that FHA mortgage insurance, goes to support. So you or your heirs would never be responsible for that 50,000 shortage. Okay, so non-recourse loans, the house will always satisfy the balance on the loan, regardless if the balance is higher than the value of the home. Okay. The cons, obviously, minimum age requirement. It's not for everyone, right? Age 62 or higher. Interest and fees chip away at the home equity. It is a reverse loan. If you're not making mortgage payments, the interest is getting added every month. It's working in reverse, just like a credit card. If you made the minimum payment, your balance is going to increase each month. You're never going to chip away at the principal. Okay. And it is only available on your primary residence. No second homes or investment property availability with a reverse mortgage. So let's talk a little bit about myths. The bank will own my home. That is absolutely false. Title remains in your name for as long as you meet the loan terms, just like on the forward loan side. If you fail to pay your property taxes and insurance, and the county came after you and started foreclosure proceedings or whatever, that would happen whether the loan was a reverse loan or a forward loan. Okay. So you still are entitled on the property. The bank is not entitled. You own it. You get to do with your home whatever you would normally do with it until such time that you choose to vacate it or sell it. Your heirs will be stuck with a big bill. Again, as I just mentioned, you will never owe more than the value of your home after the loan matures and the home is sold. The house always satisfies the loan. You have to own your home free and clear to qualify for a reverse mortgage. No, you don't have to have it free and clear. It helps in terms of what you can access, but you have to have sufficient equity in the property to be eligible for a reverse mortgage. We're going to go through an example, but typically based on age, that's got to be between 50 and 60% equity in the home. Okay. The older you are, the closer to 50% that gets. The younger you are at 62, you've got to have about 60% equity in the property. As interest rates come down, that helps access. When interest rates go up, it restricts access a little bit. Okay. So let's talk a little bit about who qualifies. All right. As I mentioned again, you're 62 or older. You have to be the homeowner. You have to have significant equity or own the property outright, primary residence, and you have to meet minimum credit and income requirements. Okay. So we do look at your credit report. We do look at your income in retirement in terms of, do we have enough income coming in, even though you don't have to make principal and interest payments? Do we have enough income coming in from pensions or retirement earnings to satisfy the requirements to meet property taxes and insurance, any debts that you currently have, car loans or credit card payments, and minimum subsistence levels to live, right? So there's charts, much like if we were doing a VA loan or something, we have to have a minimum level of family subsistence based on who's living in the house. That you have to meet. You know, it can't take your last penny here. But some good news is you can, if you're eligible for this line of credit, this home equity line of credit, that line of credit can also dissipate and give you money each month that will help meet those requirements. So it's got a nice tool there if we fell short on something there that we could access. You can do this reverse mortgage on single family homes, 2 to 4 unit properties, as long as you're living in one of them as your primary. townhomes, FHA approved condos, single unit approved condos, PUDs, townhome developments, modular homes, and manufactured homes that meet FHA requirements. So again, how much equity do I need, right? So we say at least 50%. Again, that is age driven. Actuarial tables come into play here. If the value of the home was for 100, you owed 100. There's home equity of roughly 300,000. Okay. Some people really want a reverse mortgage and even will bring money to settlement to get out of their forward mortgage and replace it with a reverse mortgage so they can extinguish those monthly payments. So they can bring money to settlement. You know, some people fall short on the equity to roll everything in. So you can do that too if you really wanted to. So how much money can I get, right? So the age of the youngest borrower or non-borrowing spouse is what we use to define the age for our calculations. The interest rate you get on the loan also impacts how much we can lend. As I mentioned, when interest rates goes down, there's more access. When interest rates are higher, it's less access. And the great thing about the reverse mortgage is, whereas if you were doing a primary loan under FHA guidance, you have county restrictions on loan sizes, right? The county and MSAs determine how high of a loan amount you can go. In a reverse loan situation, they are using the high balance limit for an FHA reverse anywhere. Okay, it's not county driven. It is one loan limit at one, and now just went up January 1st, $1,209,750. So even those people that own a $2 million property and they just want to stop making principal and interest payments can consider an FHA loan as high as 1.2 million. So it's not, as I mentioned, a loan of last resort. Affluent people who would rather invest their money differently can look at this as a means to have more cash flow monthly to do other things with. Let's do a hypothetical example and, look at what a person could be eligible for, okay? PLF means principal limit factor. It's basically loan amount size is what we're talking about. But let's look at this, right? Let's say the youngest borrower's age was 74 on the chart, and the expected rate over time on an average would be, their expected rate maybe is 5.5%, and the value of the home is 600,000. So if you look at this chart, you go to 74, go out to the 5.5%, and you have a principal limit factor of 45.8. So they take that and multiply the 600,000 by that factor, and you're eligible for a reverse mortgage of 274,800. Okay. That's today, right? So if someone didn't have a loan on that property, they would be eligible for loan proceeds of 274,800, out of which closing costs would be backed out. Okay, and closing costs are higher on a reverse. You got to figure in Virginia about 5%, because FHA mortgage insurance premium is 2%, and that is charged on the value of the home right at closing. Okay, so other closing costs on a reverse in Virginia average about 2.5% to 3%. So you want to figure about 5% for closing costs because of that FHA MIP that's charged up front. And you would deduct that from the 274,800, and below that you would have access to those loan proceeds. Not all of the loan proceeds are available to you in the first 12 months. There's a limit on how much you can take out in the first 12 months, but in month 13, the remainder of the line opens up for full access. Okay. That's just a protection that FHA put in there a few years ago in terms of proceed access. So how can you use your proceeds? And again, we have a small group. If you have a question as I'm going through, just unmute and ask me, okay? So you can use it many different ways. Let's talk the way the traditional, buckets of wealth look like right now, right? So prior to retirement, you've got your monthly income, your wages, your commissions, business earnings, pension, Social Security. You also have your nest egg, right? That could be 5 to 20% that you've saved for your retirement over your working career, right? Those are your 401ks, your lump sum savings, life insurance, IRAs, etc. That is considered your supplemental income, right? You've put that away. You're going to touch that in your retirement. And then your third bucket is how much equity you have in your home, which may or may not be accessed right now. Okay. It could just be sitting there. Okay. It's a point of pride. I understand that, but it's just sitting there. It's not working for you really, other than when you choose to access it. So let's talk about how the reverse can change that a little bit. You can take your reverse mortgage proceeds as a single disbursement lump sum. You can take it in fixed monthly advances. You can leave it as a line of credit, or you can do it as both monthly advances and a line of credit. Okay. So to give you an example of this, my father passed away in 2006. In 2008 or 9, we set up a reverse mortgage on my mother's home because she owned it outright and Social Security benefits were reduced. There was limited income coming in, and she wanted to set this up as two ways. She said, I want to put a new roof on the house and on the garage, and I want a stipend monthly. Okay. So when we did her reverse mortgage, she wanted $30,000 in cash at closing. And then we set up a stipend of about $1,300 a month. My mother is 93 years old. We just sold that home in December of 2024. So for all of those years from 2009 till 2024, she was receiving $1,300 a month in addition to her other pension benefits. She maintained the property, okay? And it was a great time to sell it. And she still walked away with some profit at the time that the property was sold. Okay. So, there was different things she could have done with that line of credit, but it enabled her to live independently, the way she wanted to live. She's in wonderful shape. It just, the house started to become needing things, and we didn't want to put the money into it. And she's now living with my sister. I don't know how that's going, but she's living with my sister now. Okay. So the unused portion of the line of credit grows. Okay, it continues to grow. The one great thing about the line of credit is it can never be capped, frozen, or eliminated due to market conditions. How many of us have had our banks come back when there's been a time in the market where properties were declining, and they said, guess what, we're capping your home equity line at here instead of there because values have declined. And you get that letter in the mail. It's like, guess what? You can't access more than this now. We're freezing it. Okay. That cannot happen on a HECM. Once it grows over time and it continues to grow over time, it is reusable at that limit. Okay. So even if you made a huge number of commissions this year and you threw a chunk of money against the reverse mortgage because you didn't want it to go too high, it still has access back to that original level. Okay. It can never be reduced. Once it grows, it grows, it grows. It is liquid home equity. It can be borrowed, paid back, and borrowed again. So again, here another example, line of credit growth, and there's a lot of tables on this and what they assume. Let's say the value at 62 of the home was 600,000 and the available line of credit was 223,000 at age 62. If you go 27 years later, okay, the estimated home value based on a typical appreciation level, I think they were using like 4% as a minimum for these calculations. They estimated 27 years later, the house would be valued at $1,024,000. The line of credit would be $1,026,000 if the borrower made no payments on that reverse mortgage over that 27 years. Okay. So again, you've got to think about how you're using that money, right? I've talked to a bunch of people that said, well, Kelly, really the principal and interest portion of my mortgage, let's say is $2,000. That's what I'm eliminating by switching this to a reverse from a forward. I'm like, okay, well, you now have given yourself 2,000 more a month cash flow than you would have had before. Okay, in addition to whatever other pension that you're pulling from, or you've just told your financial planner, I need $2,000 less from you a month because I've got this from my other sources, so you can keep that working for me over here. The other thing, my realtors love this because they'll say to me, Kelly, on the reverse mortgage, I'm not going to make any mortgage payments. I don't have to, because I don't know what I'm going to earn this year in real estate. Okay. I don't know how it's going to go. I don't know what I'm going to bring in commissions, but I don't necessarily feel comfortable having this balance grow each month. So what they decide to do is not make any payments on the mortgage. Then November comes along and they do the look back to see how much they've earned this year. And then they decide what they want to apply to the reverse mortgage to keep that balance lower, right? But they've had the whole year to decide whether to make that payment against it or not. And their financial planners are working over here to have their assets continue to grow without tapping into them, right? So the reason I say in November is because if you're going to make a payment on that mortgage, any interest that you're paying, you do want to have captured in a mortgage year-end statement so that when you file your taxes next year, you have all the information that you need. So understand the versatility here, okay, of deciding for yourself when is the best time to either pull the money out of it, make payments against it, use it as another cash flow methodology, and hold your assets working with your financial planner and pull tax-free money in off of your home here. Okay, because it's not income. You're taking money from your house. It's not income though. It's just money you're using out of the equity. A lot of common uses of the HECM, again, you could extinguish payments on the forward mortgage and replace it with a mortgage that requires no monthly payments. You can use the line of credit as standby portfolio protection, right? Let's say, you normally, as I mentioned, would pull money out of your financial asset accounts for various reasons over the year. Well, you might pull them from this instead, because if you're earning more money in your financial planning account, then you are earning equity on your home, then maybe you're just taking it out of your home instead for now and let your financial planner continue to do their work, right? Again, people use it in economic downtimes that can make those investments last longer and keep your net worth higher. You can increase cash flow to close a retirement income gap. So some people want to retire at 62, but they're not eligible for Social Security maximum benefits until 65 or 67, which is what a lot of boomers are coming into now. but they still want to retire. The game changed from when they started working. So maybe they use the reverse mortgage to close that gap before they go into Medicare, and maybe use it to pay their insurance premiums or health insurance premiums and still get to retire at 62. Okay. They can donate it, they can gift family members. It can be used as a wealth multiplier to pass a larger nest egg on to your heirs. You can use it for travel, home renovations, long-term care insurance premiums. If you have these big ticket items that come up to help protect you as you age, and that's a burden to you now in after tax earnings, you could look at it for that reason as well. So a lot of things you can do, just like you would on a line of credit, but you have no payment on this. Average cost of long-term care for home health care, about $59,000 annually. If you move into assisted living facilities, it could be $54,000 annually. And then private nursing care could be as much as $108,000 on average annually. So again, Medicaid only pays for shared rooms, and 95% of people have no long-term care insurance, and over 50% of people will need it. Okay, so a lot of things to consider here. It can help keep your adjusted gross income lower by using this instead of earnings over here that you would pay taxes on. It could make your traditional retirement funds last longer. Again, you can use it as a hedge against market risk, right? You know, depending upon where you pull your money from, you now have a different option in taking money out of accounts that could have been, let's say your 401k was hit and you get frustrated and you're like, I'm just going to liquidate it. Well, that's the worst thing to do, right? You want to keep it in there longer to recoup whatever it lost. So maybe you're pulling from the reverse to give yourself time to build back those losses in those other retirement funds. Again, you can maximize other retirement contributions and insure against longevity or pay for long-term care premiums, as we talked about. So why do this sooner than later? Okay. Well, here are some statistics for you. If you open a line of credit, the younger you are, you have a 78% cash flow survival rate of your retirement funds. Okay, that assumes 4% post-tax initial withdrawal rate based on a 32-year investment return, right? Taking it out over to the age 94, from 62 to 94. If you open it as a home equity as a last resort, you've gone through all of your other portfolio earnings, right? You still have a 60% cash flow survival rate, again, based on a 4% post-tax initial withdrawal, right? But you've dropped 18% by waiting and depleting your other retirement resources. If you do nothing and you don't go with the reverse or use it in any way, shape, or form, you basically have a cash flow survival probability of 35%. Huge decrease. Okay. So unless you're independently wealthy and it doesn't matter to you, right? There might be better ways to consider the use of your home. You just got to get out of the mental framework of, I've paid it off. It's great that it's paid off. A financial planner might say, but is it working for you? You know, you're in great health. Can we do something differently here with those assets and treat it as an asset and have you live the life you need to live longer? Again, just some, a visual of what we just discussed on the other slide of retirement duration and how long assets would last. And again, Wade Fowl is a great resource if you want more information on this. He does a whole thing on reverse mortgages and how to use this for retirement planning. A lot of books on Amazon by him will go into this. It has the top consumer protections. Every borrower has to get counseled by a HUD approved agency. You would select those counselors yourself. We have to have anti-predatory lending for this senior citizens. We want to be sure that they understand what they're doing. There are some initial disbursement limits, as I mentioned, within the first 12 months, but in month 13, the rest of the equity line opens up. We do a financial assessment. There are protections for non-borrowing spouses, meaning if the primary borrower passes away, there are protections for the non-borrowing spouse who may have been 55 years of age, let's say at the time that you did the loan, to be able to remain in the property with that reverse mortgage in place. The line of credit is secure and the unused line grows regardless of the home value. And again, that non-recourse feature, the house will always satisfy the loan regardless of if there is a gap in value versus loan amount. Can you use this to buy a home? You absolutely can use it to buy a home. It's a great way to talk to someone about why would you buy the next home in cash, when you can maintain or hold on to some of that cash and have it continue to work for you and still not have a mortgage payment, right? So you get a lot of people who want to downsize perhaps or right size in their retirement. They want to buy the next home. They're like, I'll just pay cash. I would argue that why not buy it with a reverse mortgage? You could still put 60% down, have a 40% loan to value, and still not have a mortgage payment and maintain 40% of those assets working for you over here. Okay. So again, you can keep more of those retirement assets compared to paying all cash. It just might be a strategy if you are targeting seniors in your real estate business. This is an alternative as they plan for that last home that they want to be in or next home. There are proprietary reverse mortgages outside of the HECM. They are very niche products. Banks come in and want to do reverse mortgages. A lot of them are designed for very high property values, over $1 million. These could be condos that are not FHA approved. Maybe people are 55 years old, not 62, and they want to do it in a conventional reverse scenario. These are limited product offerings by individual banks in individual states. They might not be national programs, but sometimes we get a call for something that doesn't meet the HECM scenario, and we can look at some proprietary products as well if they truly want to reverse. Loan maturity, what happens? When does this loan have to be paid off? Well, you decide to sell your home. The loan has to be paid off, okay? You decide to transfer the title to somebody else, the reverse has to be paid off. The last surviving borrower permanently moves out of the property. The loan has to be paid off. If you default, just like on any other home loan, if you defaulted, it goes to foreclosure, it has to be paid off. And the last surviving borrower passes away. The HECM has to be paid off, okay? So how does this balance get repaid, okay? The loan is not yet due and payable, okay? The borrower can pay as little or as much to the loan balance as they want over the course of the reverse mortgage. It's up to them. Or they can make no monthly payments and just still continue to pay the taxes and insurance, okay? They are not escrowed. Once a maturity event happens, like we discussed on the prior screen, the loan has to be satisfied, and that can be done by the sale of the home. Again, it's a non-recourse loan. The sale of the home will always satisfy the loan repayment obligation, and neither the borrower or the heirs will be personally reliable for any balance deficiency. Okay. So, what are some options for the heirs? Okay. The heirs, can choose a few things. So let's walk through this chart real quick. Do the heirs want to keep the home? If the answer is yes, they can pay off or refinance the loan balance. Okay. They could sell the home and pocket any of the profits. Okay. Is there any equity left? No, there's no equity left, but maybe they want to keep the home, right? Well, the heirs can purchase the home with a short payoff of 95% of the appraised value. So think about that. Let's say again, the value of the home is 300,000. They owe 350. The value comes in at 300,000. They can buy that house at 95% of 300,000 or 285 if the heirs want it. Great protection for them. They want to keep the house in the family. The house is underwater, but there's a way that they can do it. If they don't want to keep the house and there is no equity in the house, okay, they can sign a deed in lieu of foreclosure and walk away. Give it back to the bank will take it, the loan gets satisfied, and they will sell the house just like you would in any short sale or any other kind of foreclosure transaction. Any questions on that?
Hello.
Yeah.
Yeah, Kelly, thank you so much. This is Jorge.
Sure.
I'm battling here the sun. I didn't know that at this time of the day is gonna hit me
No
hard.
worries, no worries.
Yes, that's good. Now, if the person is still alive, the couple, we can refinance ourselves, isn't it? If let's say I get that mortgage, I can refinance when the time comes, and or pay it off if I had another funds, isn't it? You mute.
Kelly, we can't hear you. Can't
You are
hear
mute.
you.
There
There we
you hear
go.
me?
Yeah.
All right, sorry. If you can do whatever you want with this like any other loan. So if they're still living and they're just tired of the reverse mortgage, okay, and they say, we want to refinance it. We want to get out of the reverse. We want to stop the negative amortization. Our kids are going to come on the loan with us or whatever. You can do that no matter any time. There's nothing stopping you from doing that. But if they're moved out of the property permanently, or they've passed away, the heirs have a decision to make, right? You have to pay that loan off. Are you going to refinance the loan and keep the property that you just inherited? You can do that. Or you could sell it. It's one or the other, but you have a timetable, usually within 6 months. First, it's going to tell you it has to be paid in 30 days. If the heirs want it, though, they apply for that 6-month timetable. And then there is one 6-month extension that can be granted because sometimes the heirs want to market the property to sell it, and get it ready for sale and they need some time. But you have those two options as the heirs. But the owners, if they're still living and they want to refinance it back to a regular mortgage, they can do that. They just have to qualify like regular. Did I answer your question? George, can you unmute?
Yeah, I'm mute now. Yes, that answered my question. But I have another questions I don't know if I can post it right now. Will you keep going, or I wait until you finish?
I'm almost done. We only have a couple slides left, so go ahead and ask your question.
In the previous slide, you have there is a cap on the rate that
There is no cap on the rate. Oh, well, I'm sorry, there is a cap on the rate. It's an FHA loan.
Mhm.
So this is a variable rate like an equity line. Okay, so it might have a cap of 5% on over where it starts, but the rate is going to change every month, just like a line of credit would on a
Mhm.
HELOC that you put on your house right now.
Okay.
Okay,
Okay.
so your interest charges, you're going to go up and down within those caps, okay, over the life of the loan.
And how soon can you get it? I know that you say you have to go through a HUD counselor, and then
Yeah.
probably you can do it online too. And then so that will take, let's say, if you really want it fast, you can do it in a couple days, and then so it can be done within 15 days.
No,
No,
I mean,
okay,
a reverse loan takes longer than that, okay?
okay,
We have done loans very quickly. I would tell you the majority of them are averaging 30 to 40 days
okay.
on the purchase side. Once we do the application, the HUD counseling list goes out on the proposal, and the borrower makes their decision of the counselors will come to your house, right? They can pick and choose who they want to get counseled. We can be working the application prior to the counseling, right? So we can be working it. It just can't close without them being counseled. Okay. But on the purchase side, it's an FHA loan. Remember, the appraisal is key. If the property is deficient in any way, those repairs have to be done prior to closing. So you're not going to go with a quick timetable here, because the appraisal is everything on this loan. I would tell you to plan for 30 to 45 days. Yeah, sometimes
Okay,
longer, but you definitely want to plan for that.
okay, that's good to know. Now, on the qualifying side, that what you were talking, if let's say we're talking about $400,000, the uh, the couple getting that reverse mortgage,
Mhm.
they have to qualify for that. Let's say they own a home, and they have a lot of equity on that home, but they own a couple rental properties. And when you add it up, all of that, sometimes they don't qualify because in paper they owe a lot of money, and they do they
So
qualify?
you're going to cash flow those properties just like you would on any other loan. If you cash flow out those properties, and let's say they have a positive cash flow as a result of those properties, you're going to add that positive. If they have a
Oh,
negative
okay,
cash flow, it's going to show up as a debt.
okay,
Yeah.
gotcha, gotcha.
Mhm.
All right, well, that was great. Thank you.
Yeah, sure. All right. And again, why Fairway? We just found out we're the fifth largest lender in reverse mortgages. We lend in all 50 states when it comes to reverse. So even if you hold licenses in other states, we can get someone available to you. I'm licensed from Pennsylvania, New Jersey, and Pennsylvania, all the way down to Florida, with the exception of Georgia. Okay, I have every state all the way down with the exception of Georgia. So even if you had someone who was moving permanently to Florida as their primary residence, or South Carolina or North Carolina primary residence, we can assist them for a reverse mortgage, and I can handle that.
And you work with Dan Gay?
Oh, I know Don very well. Yeah, we're not in the same office. I'm in
Uh,
Fairfax, he's in Vienna. Yeah,
yeah, so you are here in the area. You are in the Northern Virginia area,
correct.
isn't it? Yeah. So
Correct.
if I would like to have a workshop, do you do in-person workshops sometime
We
for
can, or we
people?
could do this same presentation. Like if you wanted to do a Zoom workshop for anybody that you're targeting, we can do the same presentation for your borrowers. And I do that often with my agents to make it convenient for everybody. We tend to get higher attendance. Um,
Oh,
but yeah, we do in person as well. So
Oh, okay. So do you are gonna give us your phone number and
yeah, I'll send the presentation out,
okay,
just so you have it too after the call. And then all of my contact information is here. Mhm.
great. Thank you. Appreciate it.
Yep. Any other questions? Well, thank you all so much. That's all I have for today. And again, I'll follow up after the call with the presentation so you have it. And then if any other questions come up, just feel free to reach out to me.
All right, thank you.
Thanks, Callie.
Thank you. Have a great
Take
day.
care. Bye.